Good morning, investors, everyday homeowners, to get into investing, people that are dreaming about investing, and maybe you're already investing. But thank you for being here. I'm Mandy Brenham, known as the joint venture queen within the real estate investing world, and I'm really happy to be able to have you here today, part of my investor tribe. I'd love for you to be able to leave us some comments, write your thoughts, some topics that you might want to get some more information on. Follow me on YouTube. It is the Joint Venture Queen, and I'm happy to be able to put out there any kind of content that you might be looking for. As well, if you're interested in joint ventures, I do have a great new questionnaire that I'm able to send you. So shoot me a link with your email. I'm happy to be able to set up a discovery call for you. So this week we're like coming up near the end of the summer. Things are wrapping up. It's getting cool at night again here in Ontario. And but we're nowhere near done a fiscal year of investing. And today I have a seasoned investor with us, Laurie Peroff, a good friend. We're travel companions now. We've gone to a couple provinces together. And Laurie is bringing to us a spin on a different type of investing, which is key in our knowledge, in making sure that you know about all your investment options and which type of option is going to be best for you. So if you're going to be a passive investor, which is somebody that is hands off, you know, I've got the money, but I don't have the time, then you definitely want to watch this whole show, because this is where the information comes in. So Laurie, thanks for being here with me today.
Hi, Mandy. Thank you so much for inviting me. Time for some sweet solutions.
So I am solutions driven and Laurie is sweet deals. So we always put the two sweet solutions together, and that is Laurie and Mandy as we travel across Canada. Laurie, you specialize in private lending. Why don't you give us a little bit of background as to who Laurie May is, how we even maybe met, and what got you into the type of investing that you specialize in right now?
Wow, that's a big question, Mandy. Let's see, where did we meet? We met through our real estate networking group. Am I allowed to say the name?
I do.
Oh, excellent. So part of Keyspire, we met within Keyspire. Mandy was quite active on the forum talking about joint ventures and doing stuff at that time, mainly in Midland. And I have an uncle in Midland, so came out to meet Mandy in person, and she took me on the Midland Roadshow, and it blew my mind. It seemed like every house was either owned by her or her partner or her other partner. It was crazy. So we had a lot of fun that day. I was exhausted though. You talk really fast, Mandy.
I know.
Yeah, I do a lot of private lending, but I'd like to say that I like a well-rounded portfolio. I believe there's room for all different sorts of investments. Yes. And especially when you're the money partner, you don't want to be focused in just one area. You want to have some eggs in a lot of different baskets. I believe that equity positions, such as what you're offering, Mandy, is really great for long-term wealth, generational wealth. 5 years from now, to really get those nice windfalls and to be able to build your wealth portfolio. I got into private lending because I like to also have money today. I need to be able to pay the rent or mortgage, eat my Cheerios, as I say. And I like to eat my Cheerios more than once every 5 years. So I got into in order to get myself retired and get my husband retired, just a way to get him to stop going to work, and it's all good.
He loves it though, doesn't he?
You know what? He does love it. He's always enjoyed his job, but he came to love his job when he no longer needed it.
Right.
So now that he doesn't have to go, he really loves it.
So I love that you have this diversified portfolio. So if you're on a high level, could you share some of the type of investments? You know, so certainly no details, but maybe the types of investments that you would look at to make sure that you have a diversified investment portfolio.
Right. So on the equity side, I have some condos as well as some bungalows that I've suited. So I've done both everything from executive condo right down to basement, put a basement suite, legalized basement suite in an apartment. I do some rent to own stuff, both tenants I found on my own and with another company that handles that sort of thing. So just a little bit of dabble everywhere. I really enjoy the land development projects. Those are just sexy. That's all that is. And the returns are pretty good depending on which companies and which projects you invest in. It's a lot more homework than your typical private lending deal. But yeah, you can get some pretty sexy numbers out of them. And right now, my latest joy of life is my shipping container builds. Those are sexy and fun and so cool. So
Very
cool.
unique too. Yeah, lots of
Yeah.
people are talking about it, but not a lot of people are taking action like you are.
And a lot of people think a shipping container, it looks like you're living in a freight train boxcar. No, I can bring you into our the two builds that we're doing here in Edmonton right now. One of them's complete. It's on MLS right now. Even the guy who was installing the appliances in this home had no idea he was in a shipping container home. I told him, and he literally wrapped his head off the fridge. He was so surprised.
Wow, wow. So you do some passive lending, you do some rent to owns, you have some houses that you own, variety condos, single families that you've converted to the and then this private lending. So dig deeper. Tell somebody, what is private lending?
Private lending, boy, that's a big subject. So you can lend on mortgages, you can lend for land development, it can be business to business. Basically, it's somebody coming up to you and saying, I need some money for something, and you negotiate some terms and decide if that's what you want to invest in or not. The deals can be anywhere from, I've had one go as short as 2 weeks to as long as 7 years. And anywhere in between. You can get monthly interest, it can be interest paid annually, interest paid at the end of the term. Whatever you can negotiate is what happens. So the one that I offer, just as an example, is Sweet Deals, and that's unsecured, 15% interest, 1 year term.
So slow those down. Unsecured means?
Unsecured means you're basically betting on me and what I've decided. It means you have no security. It's a high risk loan. When you're looking at unsecured high risk investments, you're expecting a higher rate of interest. That's why 15%.
Okay.
If you look at the other end of the spectrum, very secure, almost no risk, you're looking at things like Canada Savings Bonds and GICs, and you're getting maybe if you're lucky, 3%.
Okay. So what is a description of a secured? Where would you, so if it was you, where would an investor be securing new assets? And then what would you typically say could be the difference in interest rates?
So for a secured investment, you're going to be looking usually at first or second mortgages. A first mortgage, I'd say you can earn anywhere between 6 and 10%, and you're securing then against the property that the person is buying. Typically, this is eligible for registered funds as well. So you could be using PFSAs, RSPs. Those would have to be in self-directed registered accounts, though, not self-directed like the big banks say, but real self-directed that you can go out and direct into real estate stuff. There's a few of those institutions out there. Contact me if you want to know more about that.
Yep. So somebody could have a HELOC on their house that they're paying what, 4.5%, we'll say 5% for extreme. So they have this HELOC on their house at 5%, and they could say, hey, Laurie, I heard that you're offering 15%. So if I had a HELOC that I had $100,000, just describe that, walk me through that process.
So we'd be talking probably about the Sweet Deal unsecured then, my Sweet Deal. So you'd be earning 15% interest for a 1-year term. It's a super complicated process, Mandy. I'm not sure if you have enough time on this show for it. I'm joking with you. But it's a 1-page form. Your name, address, and how much you want to invest. So for $1,000, I would have you fill out the lender information form. From that, I would create our loan agreement. I would send you that for review. By all means, take it to your power team, have everybody vet it and look at it. They're going to tell you exactly what I'm telling you. It's high risk, unsecured. You better trust the lady. Okay. But at anything over 50,000, I do offer monthly interest. So for the 100,000, you gave an example, I'd be depositing $1,250 into your bank account every month.
Wow. Okay, so that's the Cheerios today that you're talking about.
The Cheerios today. Yeah. Now, in the meantime, you have to pay 5% interest. That 5% interest that you're paying over there is a tax write-off, but you will be taxed on the money that I'm sending you as well. So it's a bit of a wash that way. You're making the spread, and you'll pay tax on that spread.
Okay, good to know. Good to know. So there is a tax implication. But so really, I'm borrowing at 5, lending at 15, and making a 10% spread by literally writing you a check.
Right. So basically $1,000 a month is going into your pocket. 250 is going to pay for the loan.
Right. And this is good for somebody who can't qualify for a mortgage, wants to be able to get into real estate, wants the returns that real estate can offer, but doesn't have, likes the time factor of being able to just write a check, likes the time factor of knowing that my investments are set for a year. I have heard of other people who are like, oh, I want to do, 4-month or 3-month terms, turn my money over every 4 months or every 3 months, 4 times a year. However, like I can't even think that much because I know how much work it is. And so what do you think the benefits, the drawbacks and the benefits are to a 1-year term compared to maybe a slightly higher interest rate, but every 3 months? Like, what are some of the other negotiation terms that people might be looking for on a loan?
There is some work involved. It's not as much work as most people think, but you do have to vet your project. You have to do some due diligence. There is some paperwork involved. And if there's security, there are costs involved in getting that security set in place. For example, to register a caveat on title or whatever you're getting in particular security. So I'm not as keen on the shorter turnarounds. Usually for those, you would be looking at, say somebody's doing a flip and they need the funds in order to do the renovation project.
Okay.
That would be a typical deal that would be one of those shorter terms. And they're projecting maybe it's going to be 2 to 3 months to do this flip. I would then make the loan agreement up to 6 months because you want to make sure that if anything runs over, perhaps have an 3 months with a 3-month extension possible. Either of those are likely. But it's a lot of work for me to go and take the money out of wherever it is and get it to that person. And there's some costs usually involved in that. So frequently a shorter term like that will also have an upfront lender fee associated with it. The fee is set there in order to offset my costs. So basically the borrower pays for all the costs I have. My money.
Right. And a renovation loan is an unsecured loan. It's not being registered on title, or what do you?
It can be either way. It all depends. So if you're doing a flip, and I've done them both. So if you're doing a flip and you don't have the room on this particular project, then it's unsecured. You're going to be paying me higher interest. If you do have, say, another home that you own, that you have enough equity to cover this money that you need for this flip, you might be securing it against that home.
Okay.
Project secured against home A to work on project B. And in that case, you'd probably pay a little bit less because now I've got 100% security. I'm feeling pretty good about this. I don't need to make quite as much interest on that project.
Right, right. Okay, so now jump to worst case scenario. Have you ever lent out money that you have had a difficult time to come back? Maybe walk an investor through that to be able to say, you know what, it does happen. When it does happen, these are some of the things that you can do to be able to walk it. You know me, I never like to pretend that side doesn't exist. I like to say, let's talk about it. Let's make sure that everybody knows. So
that's one of the things, especially if you're doing high risk unsecured loans, that you should have in the back of your mind. Never lend more than you can walk away from.
Okay.
So if you lose it, that is an option. That's what high risk unsecured means, that it could all go away, which obviously is not the best case scenario. I have had one of those that I lent out the money and the guy disappeared.
Okay.
I chased him. I have managed to get default judgment against him, and whenever he gets employed, I'm going to be garnishing his wages. I had to pay some legal costs for that. All of that, though, was written into my loan agreement that if I had to pay legal costs to get my money, that's your problem, buddy. So now he owes me that as well.
Okay. Okay. And, but again, the amount that you lent him was something enough to be able to be like, ow, that hurt, but not like arm cut off, debilitating.
Never, never, never gamble the mortgage money
Right.
or the Cheerio money. It's like going to Vegas. Don't take what you can't afford.
Right.
Now, there's some good money to be made if you're willing to do some high risk, but make sure that's money you could afford to lose in the worst case scenario.
Oh, that's super super important. So now you, if I'm correct on here, let me know that you have investors from every province in Canada.
I do. I'm very proud of that. I have yet to get a couple of territories. So if people are in the territories watching, give me a shout, please. I do have every single province from Victoria. I've got Halifax, PEI, all the provinces. I'm so pleased with that.
And in our time that we went to Montreal, there are quite a few little nuances in every province. How does that, if an investor is sitting there in one of the provinces, what are some things for people to kind of be able to look for in, can I even do that investment with some of these larger companies? How does that affect province to province?
So that is more things that are based by the Securities Commission. So the Securities Commission is regulated by each province and by each territory, and there's different rules for accredited and non-accredited, accredited and eligible investors, and friends, family, and. Can
you touch on those? Can you describe those? Because I always need a refresher on those.
Right. So basically, the federal government has kind of set those rules a little bit, and then it's up to each province that tweaks them a little bit. An accredited investor, according to the federal government, is somebody who has generated enough wealth that they really don't need anybody else's advice or counsel in order to make their own decisions in investing. They're usually allowed to invest pretty much whatever they want in whatever project they want with whatever documentation they feel they need.
Okay.
That to reach that status, most provinces require you to have something like $200,000 income per year by yourself for the last 2 years and anticipate it for the next calendar year, or $300,000 combined income with a spouse per calendar year and expect it again. There's some fairly high standards. You could have $5 million in property or other assets, or $1 million in liquid assets. So there's some pretty lofty targets, and obviously you must have some sort of wherewithal, some sort of knowledge in order to have built that sort of wealth. And that's what the government's saying. You can go ahead and do what you want. The government also feels that most people are eligible investors. That's almost everybody. If you have a job and you're doing okay, you're probably an eligible investor. They cap those kind of to protect yourself. Sometimes you get onto something, you think it's a good deal, it's a sweet deal maybe, and you don't want to put all your eggs in one basket, just in case. So eligible investors are in most provinces capped at about $30,000 per year that they're allowed to invest in stuff like this using their registered funds. So RSP, LIRA, TFSA, RIF, all those sorts of funds.
Awesome.
Yeah, actually it is pretty awesome. And those, to be an eligible investor now, you're usually earning, I believe it's $75,000 per year as an individual, or I'd have to check, Mandy, it might be $120,000 for the couple. And it might, yeah, I think that's about right. And I think it's $400,000 of total property after all debt. So if you own 5 places and your equity is $400,000 or more in those properties, you'd be okay to be an eligible investor.
Okay.
And then the last category is friends, family, and business associates. So if you and I are friends and we've been friends for a long time and you thoroughly trust me and it's okay, there's a box you can tick and that removes that $30,000 cap from you as an eligible investor.
Okay. Okay. Wow. So it's important for people to have an idea, and there's so many different lending institutions out there, or not even in lending institutions. What do we call the Greybrooks, the pro funds, the REITs, all those kind of things? Because all of those people are sanctioned by the federal limitations, right? So
Right. So they're offering secured investments, and those are being secured. Those have to be secured in order to be eligible for the registered funds. So as soon as
Okay.
you can use registered funds, there has to be a degree of security involved, and a lot of scrutiny. A lot of scrutiny is given to those particular projects. One thing you should be aware, though, Mandy, that's frustrating, I think, for a lot of people is those institutions that you've just mentioned. Many of them have minimum investments of
Yes.
$50,000. So at 50K, and if you're an eligible investor, you're only allowed to invest 30K a year. You're not allowed to do those. So you have to find ones that don't have those minimum investments.
Right. Yes, yes, yes. I have Eli from Montreal. We met him at our Montreal meeting, and he said he's looking forward to the RSP loan to be in effect. So
Yes.
that's a Quebec thing.
A little bit longer on that one, but
Yep.
We're working through it. So we have a couple of projects that it's very important that we do our due diligence on land development projects and make sure there's enough money to pay all the interest and make sure that everything is going to be profitable so that it's a win-win-win for everybody.
Absolutely, absolutely. So you touched on the accredited, eligible, and the family and friends, and we were going to just talk about maybe a little bit of the differences of each province, what you have found along the way. That why would one allow it and another not?
That's a really good question. You know what? It all has to do with their own securities commissions. And to be honest with you, Mandy, I didn't do as much homework before this meeting as I probably should have. So I'm working hard to remember what the differences are in each. Most of them are as I described, but there are BC, I know, is a little bit different. They have to sign a risk acknowledgement form that says this is a risky deal and you could lose everything. And it's not Greybrook makes you do that too. It's the most frightening paperwork you're ever going to see in your life. I had been involved in probably 6 or 7 Greybrook deals before this form got added, and even I'm going like, oh my God, I don't know if I want to do this. Yeah, but it's just do your due diligence, and if it's a good deal, it's a good deal. Go for it.
So I'm gonna because you wear the shoe and you offer the shoe, shall I say? So you are a private lender yourself, and you offer private lending. I'd love some of your experience on what is we touched on due diligence of so if I'm lending you the money or I'm lending that person that's doing the renovations, maybe just off of your mind, because I know you probably tick these boxes faster than other people even know that those boxes exist. What are some of the things, some of the due diligence touch points that you look for in a private lender?
Great question. Again, it's all project based. So when you're a private lender, I'm way more interested in the project than I am in you as an individual.
Okay.
That said, I need to have a lot of trust in you. I need to know that you're going to pay me. You're going to pay me back on time, in full, agreed. So I make sure that there's language in my loan contract that specifies that gives me comfort in those. But that aside, that's probably about 20% of my concern. 80% is using the money. Is there really the profit in that you think is? What if the market goes bad? What if the market goes good? How is that going to change the return? Does it change my return? So all sorts of questions I'm looking at. If it's a flip project, I want to know that you've done some flips before. What is your history on these? What do they look like? Have you had one go bad? If you haven't had one go bad, I'm going to kind of question you, because I'd be a little surprised that you made exactly what you thought you were going to make every time. It's not HGTV. We're not watching some of these shows, but you know, poop happens in these deals, and I want to know how you handle that and how that possibly affected your investors.
Yeah, yeah. I've been on holidays, like I was kind of describing. We've come in to do this show because that's how much I love doing this. But while I was away, I have chatted with friends, investors who are friends, and realizing the importance of being able to call somebody. So I had 2 people call me this week because I was the person that they were like, I just need to be able to be like truthful with you, but I'm finding myself in this uncomfortable spot. what do we do? How do we go about this? What are the things? And so it's so raw to be able to tell somebody, right? Here it is, you're asking somebody for money and they're asking you, well, tell me about something that's gone wrong and how you dealt with it. Our pride tells us, well, I'm just the best thing since sliced bread. And you're like, actually, the private lender wants to know when your permits were delayed, when your contractor walked away, when your appraisal didn't come back, when whatever, they want to know that.
And if and how does that affect their return? So depending on the loan agreement you have, if there's any equity component in it, that will affect your return. One of the ones I like that I've seen a bit of lately are, I personally don't do them, but I've seen them and kind of think they're interesting. A 5%, for example, a guaranteed 5% interest rate with an equity portion for the lift. That's pretty nice in markets that are a little bit more volatile. So you know that you're going to get this, and if it goes up, you'll get to participate in the lift, and if it goes down, well, at least you're getting that 5%. It gives a lot of comfort when you're making a loan, which is kind of interesting.
Well, yeah, because even right there with our $100,000 HELOC example that I might be paying 5%, if I'm coming into this deal, it's not actually costing me any money. It's like, look at, the project will factor in that 5% to be able to cover my costs, but I'm also into it for a certain percentage of equity, right? And that makes it pretty advantageous.
One of the things I have learned, back to your due diligence question, one of the things I have learned is definitely take a look at the projects that people are giving you. Not all of the projects that I see are coming from Keyspire. So they're not all standardized, and you have to kind of look past that and understand. So if the return looks amazing, I'm going to make 50% ROI. Oh my gosh. Is that annualized, or is that for the 5 years of the project? Is that what you're making, or is that the total project that you're now splitting with the builder or with somebody else in the deal? So have a look at those fine details. And if there is an interest component that's being paid, is that payment actually part of their projection numbers, or is that just something they're taking out of the profits at the end?
Yeah. Yeah. And when you're calculating ROI, is that, what's included in your cash flow numbers? Oh, well, we self-manage and it's a brand new building, so there's no maintenance and whatever. And you're like, whatever. There is always maintenance in buildings. There's always a maintenance there. So again, we have within the group that we're part of, it's very standardized. Everybody talks the same language, but you kind of go outside of that and people are, oh, well, I don't include that, and I don't include that, and I don't include vacancy. And you're like, okay, well, but unless...
Well, let me rerun the numbers, including vacancy and property management and all this stuff, just in case. Because if a deal goes bad and my security is your property, then I need those numbers included in that property for when I might have to own it and run it.
Absolutely. Absolutely. So we're here at the end of our show, but what the value of our show today is to be able to say that you can get into real estate in so many different vehicles. And I know although my accountant will tell me that I need to diversify outside of real estate. So even though we're talking about diversifying within real estate, to be a private money lender, to do a rent to own, to do a long-term equity hold, to do a generational wealth, but to put some Cheerios on our table every month as well.
Yeah, I like to eat my Cheerios every day.
I think of you whenever I see a Cheerio box. You know what? I think of you with purple. Purple. Laurie May is sweet home, sweet builds, and anyone can find you. Where can people follow you or find you or get some more information about your stuff?
Probably the easiest way to get more information is from my website. So it's sshbuilds.com. So it stands for Sweet Home Builds. .com, or if you want to talk to me directly, my email is info@sweetsweethome.com. Yes, it's spelled differently. I see Larry put it on. Thank you, Larry.
Yes, sweet.
Yeah, sweet like chocolate, sweet like an apartment, all at home.
That's a good way to remember it. And we're Sweet Solutions together, you and I.
Yeah, that's our travel net tag name, Sweet Solutions.
So I thank you very much, Laurie, for your time today, your knowledge, your wisdom, and our laughs. So we always have when we get together, because, you know, we can't take this investing thing too seriously. There's got to be some fun in it here, right?
Absolutely. If it's not fun, do something else.
So thank you, everybody, for tuning in. That's another episode of The Full-Time Investor. I'm Mandy Brenham. Again, feel free to come and join my tribe. Follow me on Facebook, Instagram, and YouTube at Joint Venture Queen. I will see you in a week with another exciting guest. Have a great